Look, I wasn't going to make this video. I'm literally sitting here, coffee getting cold, about to start working on something else. Then I see the Economic Times report. $3 trillion wiped, gold and silver, in minutes. No Fed announcement, no macro news, no geopolitical event, just a vertical drop that looked like someone hit the sell button on the entire precious metals complex at the same time. Silver down 40% in 3 days. Gold cascading in a way that doesn't happen in normal market conditions. And I stopped because someone needs to explain what actually happened here, who had the positioning to benefit from it, and whether this was algorithmic chaos or something more deliberate. I'm recording this right now from Denver, and I want you to comment what day and date you're watching from, because this story moves fast, and I want the timeline to be crystal clear. And real quick, if you value this kind of calm numbers first breakdown, where we actually look at the mechanics instead of just reacting to the headline, do me a favor. Subscribe and comment FinTalk OG so the algorithm knows you want more of this. Now here's the claim making the rounds. $3 trillion evaporated from precious metals markets in a single session. Silver crashed 40% in 3 days. No obvious trigger. And the two explanations you're hearing are either it was algorithmic, high-frequency trading gone wrong, a flash crash caused by machines, or it was deliberate, a coordinated move by institutions that had positioning ahead of time and profited massively while retail got liquidated. And on the surface, both sound plausible. But when you slow it down, piece by piece, you realize the first place these stories usually get weak is when they try to make it binary, either algos or manipulation, when the reality is both things can be true at the same time, and the line between them is thinner than most people realize. So I'm going to break down 3 things. First, what actually happened mechanically during that session, what the order flow looked like, where the selling came from, and why it moved the way it did. Second, who benefits from a move like this, not in theory, in practice? Who had the shorts, who had the liquidity, and who was positioned to profit? And third, what this means for you if you got liquidated, if you held through it, or if you're trying to figure out whether this was a one-time event or a preview of how the market is going to trade going forward. So let's start with what we can verify. In a single trading session, gold and silver dropped in a way that looked more like a technical glitch than a market repricing. Not a slow grind, not a steady decline. A vertical cliff. Silver lost 40% over 3 days. Gold dropped hard enough that it triggered circuit breakers in some derivative markets. And here's the key detail. There was no macro news. The Fed hadn't announced anything. There was no surprise inflation print, no geopolitical shock, no major sovereign entity announcing they were dumping their reserves. The news came after the move, not before. Which means the move itself was not a reaction to information. It was a reaction to positioning, to liquidity, to order flow dynamics that had built up in the background and then unwound violently. When I traced where a lot of the initial selling was coming from, it wasn't retail. Retail doesn't move $3 trillion. It was institutional. It was algorithmic. It was large block orders hitting the futures markets, which then cascaded into the spot market, which then triggered stop losses, which then forced liquidations in leveraged positions, which then created a feedback loop. Think of it like this. Someone puts a large sell order into a thin market. The price drops. That drop triggers automated selling from algorithms that are programmed to follow momentum. That automated selling hits more stop losses. Those stop losses force long positions to liquidate. That liquidation creates more selling pressure. And within minutes, you have a cascade that's no longer driven by any single entity. It's driven by the structure of the market itself. That's how flash crashes work. They start with a spark, but the fuel is already there in the form of leverage, algorithmic trading, and stop-loss orders stacked on top of each other. Now here's where it gets interesting. If you look at the institutional positioning data from the weeks before this happened, and this is publicly reported through CFTC commitment of traders reports, you could see that large speculators, which is the category that includes hedge funds and institutional traders, they had built up significant short positions in both gold and silver, not record shorts, but elevated. And if you're short and the market suddenly drops 40%, you make a lot of money very quickly. So the question becomes, did those shorts know something? Did they have information that a crash was coming? Or did they just get lucky? Or, and this is the uncomfortable possibility, did they help create the conditions for the crash by adding selling pressure at a moment when liquidity was thin and the market was vulnerable? Here's a question for you. Do you think a move like this, 3 trillion wiped in minutes, do you think that's possible without some level of coordination? Or do you think algos and leverage alone are enough to explain it? Drop that in the comments because I read them and I want to know how you're processing this. Now let's talk about liquidity, because this is the part that most people don't understand, and it's the key to understanding why this move was so violent. Liquidity is not constant. It changes throughout the day, throughout the week, depending on who's trading, what time zone they're in, and what other markets are open. If you hit the precious metals futures market at a time when Asian markets are closed, European markets are winding down, and U.S. markets haven't fully opened yet, liquidity is thin. That means there are fewer buyers willing to step in at every price level. So when a large sell order comes in, instead of being absorbed smoothly, it has to drop the price further and further to find buyers. That's what creates the vertical move. It's not that the fundamentals changed, it's that there weren't enough bids in the order book to catch the selling. And here's the clean way to think about it. Imagine you're in a crowded restaurant and everyone decides to leave at the same time. If there's only one door, people get stuck. They push. Someone falls. It creates chaos. That's what happens in a market with thin liquidity and heavy selling. The exits get crowded. The price has to drop to create space. And the people who get hurt are the ones who didn't see it coming, the ones who were leveraged, the ones who had stop losses that got triggered at the worst possible prices. The people who benefit are the ones who were already short, the ones who had liquidity to provide, and the ones who were waiting on the sidelines with cash ready to buy at distressed levels. Now here's the skeptical alternative. Could this have been entirely algorithmic with no human intent behind it? Yes, it's possible. High-frequency trading algorithms are designed to react to price changes in microseconds. If one algo starts selling, other algos detect the price movement and start selling too, not because they have a view on gold or silver, but because they're programmed to follow momentum. That can create a cascade that looks coordinated, but is actually just machines reacting to machines. That's plausible. Here's how it can fail. If it was purely algorithmic, you'd expect to see the same kind of flash crash happen randomly in other assets with similar market structure. And we don't. Flash crashes in precious metals are rare, but not unheard of. When they happen, they tend to happen at moments when positioning is stretched, when sentiment is fragile, and when someone, human or machine, decides to test the market's ability to absorb selling. That suggests there's more to it than just algos gone wild. And I'm going to say something that might annoy both sides. It doesn't matter if it was manipulation or a test or an algorithmic accident. The result is the same. If you were leveraged, you got liquidated. If you had tight stop losses, you got stopped out at terrible prices. If you were holding physical with no leverage, you're fine. You just watched your account value drop and then recover, assuming it did recover. The mechanism matters for understanding how to position yourself going forward. But in the moment, the mechanism doesn't change the outcome. You either had the risk controls in place to survive it, or you didn't. Now let's map two plausible paths without pretending we can predict the exact candle. Path 1. This was a one-time event, a liquidity crunch, a positioning unwind, a perfect storm of factors that created the crash. The market stabilizes, buyers come back in. Gold and silver recover most of the losses over the next few weeks. Retail gets shaken out, institutions accumulate at lower prices, and the bull market resumes. That's within the set of things this market is capable of doing. Path 2. This was a test. Someone, or a group of someones, wanted to see what would happen if they hit the market hard. They wanted to see where the stop losses were, where the weak hands were, and how much selling it would take to break key technical levels. And now that they know, they do it again. Maybe not immediately, maybe in a few months. But the playbook is written. You hit the market when liquidity is thin, you trigger the algos, you force liquidations, and you profit on the way down. Then you cover your shorts at the bottom and ride it back up. That's also plausible. Both of these worlds can be true in different timelines. I'm not predicting it. I'm saying both fit the structure we're seeing. Here's what to watch. First, watch the CFTC commitment of traders' data in the coming weeks. If the institutional shorts that built up before the crash have been covered, that suggests this was a trade that's now over. If those shorts are still in place or building again, that suggests they're expecting more downside or they're setting up for another move. Second, watch liquidity conditions. If you start seeing wider bid-ask spreads, if you're seeing thinner order books, if premiums on physical metal are spiking because the paper market is dislocating from the physical market, that's a sign that the market is fragile and vulnerable to another event. Third, watch the recovery. If gold and silver recover quickly and make new highs, that suggests the fundamentals are strong enough to absorb the shock. If they chop sideways or make lower lows, that suggests the move broke something and the market structure has changed. Now here's the uncomfortable truth. If you got liquidated during this move, it's not because you were wrong about the long-term thesis, it's because you were sized wrong for the volatility. Precious metals, especially silver, can move 40% in 3 days. That's not new. That's the nature of the asset. If you're using leverage, if you have tight stops, if you're not prepared for that kind of move, you will get taken out even if you're right about the destination. And this is why position sizing is not a luxury. It's survival. The people who survived this move, the ones who are still holding, they're the ones who weren't leveraged, who didn't have stops that could be hunted, and who had the emotional capacity to watch their account drop and not panic. So what do you actually do with this information? Here's a simple action plan. No drama. Step 1. If you're using leverage, reduce it or eliminate it. $3 trillion wiped in minutes should tell you that the market can move faster and further than your margin can handle. If you can't survive a 40% drawdown without getting liquidated, you're too big. Step 2. If you're holding physical with no leverage, this doesn't change your thesis. Physical doesn't have margin calls. Physical doesn't get liquidated. You just have to have the stomach to watch the volatility and not sell at the bottom. Step 3. If you got stopped out, don't chase it back immediately. Wait. Let the market show you what it's going to do. If it stabilizes and starts to recover, you can re-enter. If it keeps dropping, you avoided more pain. Step 4. Don't use tight stop losses in volatile assets. If you're going to hold precious metals, you need to accept that they can swing violently. If you can't accept that, don't hold them. Use stops that are wide enough to survive normal volatility, or don't use stops at all and just size smaller. Now, here are my questions for you. Do you think this was algorithmic chaos, deliberate manipulation, or something in between? And if you were holding during this move, did you sell, hold, or buy more? Drop your answer below and remember to include what day and date you're watching from. If you got value out of this, subscribe and comment FinTalk OG so I know you want to follow up when we get more clarity on what actually happened and whether it's going to happen again. And if this helped you, share it with someone who got caught in this move and is trying to make sense of it. All right, stay sharp, and I'll talk to you soon. And just so we're crystal clear, this is educational content. It's my take based on publicly discussed information and my own reasoning, and it's not personal financial advice. I'm not your advisor. I don't know your goals or your risk tolerance, and I could be wrong. Do your own homework. Consider your situation, and if you need personal advice, get it from a qualified professional who knows your situation.